Hi, my name is Casey Bell, and I'm a graduate student at the California State University at East Bay. And in this presentation, I will be going through my risk assessment questionnaire for the capstone project. The following questionnaire is a series of questions that will help determine risk exposure to your company. The questions and topics are a result of extensive research regarding why construction firms fail, as explained in my written narrative that you can also review. Several of the financial metrics that were determined was from looking at how companies in the industry actually assess subcontractor risk and general contractor risk. From this research, I identified several factors that led to the failure of specific firms. The objective of this assessment is to give you basic insight as to the business risks that may be occurring in your construction company. Because every firm is different, these risks are broad, based on business principles specific to the construction industry. There may be significant risks specific to your type of work, environment, location, and more. The objective here is to raise awareness of these risks I have found so that your firm can put in place mitigation strategies and procedures to reduce your chance of exposure. At the very least, my objective was to get your management team thinking about these possible risks. As you'll see, I have based the risks on points, and these points are based on percentages of severity of the severity of the risk that I've determined from my research. The higher the point value, the more detrimental the risk is. The points will be totaling at the end and be ranked on and based on my risk equation. The equation will identify the level of risk that your company is experiencing. In the narrative, each of these risks are explained in depth. I suggest reading the narrative prior to starting the risk assessment. Also, you may refer to the narrative at any time during the risk assessment to clear up any questions you may have about your answers. So, as I'll show you, we will start by filling out each tab in order, and I'll only populate the yellow cells. The cells not highlighted will self-populate. And also, for the yes and no questions, I want to make sure that you know to put yes or no, those exact words in order to populate the equations correctly. Overall, make sure you're honest about each question. Many are broad and can be interpreted in different ways. But in order for this assessment to be effective, you need to think about each question honestly. Also, there are several items that require financial information about your company. It's important that you make sure this information is accurate and available. If you not have this information, I suggest you work on getting it. However, for this assessment at this time, you can use a well-educated guess to answer. So now go to video 2, and I will go through each question in depth. We'll now begin going through the assessment questionnaire. I've structured the questions based on, first we'll start with financial risks, then we'll go through managerial risks, and then we'll go into uncontrollable risks and how to determine them. So first we'll start with insufficient profits as being a risk to construction companies. So profits are different for every project and every firm, but knowing the amount of profit that will allow you to sustain business by being awarded jobs, being the low bidder, and knowing how much profit you need to set to make it worth your while is critical. In order to determine if your company is setting correct profit percentages when bidding jobs, you need to have past information. So we're going to go ahead and fill out the sheet for my mock company, and first start filling the yellow cell here for the profit percentage that your company must sustain once you have thought about the profit extensively. This is your base number. What do you want your company to make on an annual basis? For our purposes, we'll be using 4%. So my company does a lot of different projects, and we're a general contractor. And I've set this profit history analysis portion, so we'll go through about 5 projects here. And I've already filled this in, so we don't have to go through each one, but I will go through the last one as if we were bidding on a bank project. So on the left side here is your project name, and this company, my bid price was, say, $600,000. And the profit I set on this job is about 3.2%. So we decided to go in a little lower on this than our actual profit that we want in the beginning, based on the project conditions, let's say. Now the winning bid price for this project was actually $575,000. So we did not win this project. As you can see, bids won or lost on the bottom here. On this project, we did not win, and the difference in the price was $25,000. So the contractor profit percentage to win the job, assuming that you're only looking at profit, would have to be around 3%. And so go through the past. You can even extend these columns to make it more accurate, but we're just going to look at 5 jobs going through past examples. And this last column here, the profit at job completion for the last projects, looks at how have your projects performed. And I used examples in here at 6%, 4.5%, one being lower at 1.3%. So that project at the end of the day was not quite as high as you'd want. So once you've filled out this information here, these cells down in the bottom populate. So our average profit percentage to win projects was 3%. Our average actual profit percentage at job completion for the past jobs was 4.4%. And then our average actual profit covering what we finished at the end of the day on the past 5 jobs was 3.7%. And so the difference between our actual profit and our desired profit was negative 0.3%. So what we've set to earn in the beginning minus what we actually did. So we did not quite achieve the profit percentage that we wanted, but we were only off by 0.3%. And so now we go into the points value. In order to determine how many points we get in this section, we have to answer these questions. So is the difference within plus or minus 1%? Yeah, it is. It's negative 3.3%. So in this category, we've earned the top points, which are 25. So if the difference was within plus or minus 3%, you get the middle. But in our case, no. So it's going to be 0. You know, it doesn't matter. If the difference is plus or minus 5%, so if we were 5% off of this plus or minus our base of 4%, we would get the least amount of points, which I believe is 0. So our total is 25. We'll now look at insufficient capital, and we will do this by determining the current ratio. So the current ratio is computed by dividing your current assets by your current liabilities, and it's expressed in a mathematical term. Having enough capital is critical in construction because projects need to be funded before you actually receive payment. Based on what I've found in research, the optimum current ratio is about 1.3%. And we go into determining the current ratio and what the current ratio actually means in the narrative quite extensively. So I would suggest, if you don't know what your current ratio is and how it's determined, you should go and read the narrative. So for my company, I use an example of having a current asset at about $500,000. So total current assets of $500,000. So current liabilities, what I still have to pay out, or maybe loans or whatnot, I have at $390,000. So I had to populate that. Now the self-populating current ratio box here is 1.28. So that is my current ratio, 1.282. So now we'll go down and look at the points. So is our current ratio between 1.25 and 5? This is going to be our top earning point section here. So in this case, we did great. Our current ratio was 1.28. So we'll fill in yes. So if my ratio is between 1.51 and 2, or 1.25, or 1 and 1.25, then I would put yes here, but it is not. So we're at 1 because we are at 1.28. But this is the middle category. So you're not below 1, but you're not quite as high as you need. You don't have quite enough current assets than you would need, in my opinion. However, you're not so high. You're not over 2. The next one is the current ratio under 1. Then the total points would be 0, because you won't have enough money to stay afloat or fund anything. And then if the current ratio is higher than 2.5 or less than 0.75, then you'll have 0, because you will not have money to fund any projects, and you have too much and not enough liabilities. So our suggestion down here is our capital is sufficient because we do have a current ratio at 1.282. We'll next look at leverage. So we'll now look at leverage. Leverage basically determines your borrowing power. And in construction, it's vital that you are able to obtain loans, because you need money to start projects and run your operations for a decent period of time. If your company does not have significant borrowing power, then you are at risk, because you will not be able to fund the jobs that you're awarded, and you will essentially go out of business. So this analysis will look at how much you're liable for compared to your net worth. So the first box we'll fill here is our total liability. So what do we have left to pay out? And fortunately, we have a $30,000 amount of total liability. And my company has a total equity of $230,000. So our leverage ratio is 1.3. It's not too good. And so we'll look at how many points we'll be able to earn. So is the ratio greater than or equal to 2.5? And no, it is not. It's a ratio between 1 and 2.5. No. Is the ratio less than 1 but greater than 0? So yes, we receive 5 points for that. And is the ratio less than 0? No, obviously it is greater than 1. So we have reached close to the middle category here, and unfortunately, my company's borrowing power is not that great at this time. Next, we'll look at cash flow. We'll now go through our cash flow, and we'll look at net conversion days. The net asset conversion cycle, or cash conversion cycle, tells you how many days it takes for you to receive your money after the asset has been expended. Because in construction, most contracts explain that billing occurs at the end of the month, you are forced to fund your project for the first 30 days, or sometimes net 45 days. So ideally, the net asset conversion period should be between 30 to 35 days. So we're going to go ahead and fill out the cells below here, and we're going to start with our receivable turnover days. So this is how many days it takes for you to get your money once it's been expended from your project owner. So in this case, it takes us about 35 days to get our money back. So my firm has inventory. We do some self-perform work, and our inventory turnover days, once the product is in our warehouse and out in the field, it takes about 20 days. So our payable turnover days, how fast do we pay our subcontractors or our vendors, is about 40 days per my contract that I've set up with my subcontractors and vendors. So my cash conversion days is 15. I have a pretty high conversion, or pretty low, conversion day for construction, and because of that, I have earned the top points. And this may be because of my payable turnover days, it's pretty good. Sometimes it may be 15. So if it's lower, say I have a two-day payable turnover, then you can see my cash conversion cycle goes up. But we have 15. 40. So our net asset conversion day is under 35. If it's between 35 and 55, you get the next points, I believe, is 10. So, and so on and so forth on each item here. So my suggestion is we have good cash flow cycle. Bad debt or doubtful accounts are contracts or clients that owe you money for completed work or current work, and they will not pay for it or have not paid you for it. When a contract becomes doubtful and is not paid, this is considered a bad debt. We'll look at percentages of outstanding bad debt. Bad debt is pure profit. So basically, this money that you're not receiving could go straight into your profit, and that's why we consider it so detrimental to a company. And anything over 3% of receivable revenues that you're not obtaining is threatening to the firm. So we'll first fill in our total accounts receivable. And our accounts receivable to date it's about $600,000 for my firm. And accounts that we have not received or cannot receive that are outstanding it's about $5,600 that we have outstanding. So our bad debt percentage is 0.933%. So we've done a good job going back to our clients and requesting that we get paid, and we don't have too much money tied up in, I guess, lawsuits. So is the bad debt percentage less than 3%? Yes. We get 10 points. My next category is it between 3 and 5%? So it's in the middle because it's less than 5%, so it's not that much, but it's definitely over 3. So that's no. And is the bad debt greater than 5%? So this is a 0. Because if it's more than 5%, you're essentially losing 5% of profit. So my suggestion is, bad debt is not threatening to the company. I say to make sure to set cash as a placeholder to balance the books, though, and we talk about that in the paper. Equipment management can be a large part of the construction costs. When preparing an estimate, the cost of equipment needs to be figured depending on if the company owns or rents the equipment. The problem is that the cost of equipment can be severely understated, which in turn will cause the company to lose profit. I go through in the narrative as to how to calculate and estimate how much your equipment costs and why it is so detrimental. So in this category, we look at the points based on a question, no financial or numerical metrics. So do you calculate the cost of a large equipment, including fuel, tires, tracks, tire tracks, amortization of major repairs, and hard and soft shop costs? And are these costs updated monthly? My firm does a lot of self-perform, as I've stated, and so we do track these costs. However, I don't believe, honestly, I can answer this question yes, because I don't really have a sheet explaining each of these and calculating them on a monthly basis. I actually do it quarterly for my company, but not monthly. So I'm going to answer this honestly and say no. Similar to the equipment management, this is another questionnaire without numerical metrics, and it is job cost tracking and work in progress. Tracking job costs may be one of the most important tasks of the project manager. Without tracking costs, how will you know if your project is on budget or under budget? The job cost tracking can be simple in a simple Excel spreadsheet or complex program that some of the major companies use. The work in progress for a company essentially determines the percentage complete of a job and if the job is profitable or unprofitable for that company. This can be a simple spreadsheet or, again, a complex software to determine based on how much work your company does. So the first question is, do you have a job cost tracking system? Yes, I do. I track my costs for my company on Excel spreadsheets. Are your indirect costs calculated and distributed monthly? So these are costs that you can't necessarily bill to a project. So your overhead costs, do I distribute them throughout the projects, or do I just calculate them and let them sit? So I do distribute and calculate these costs. Are your indirect costs calculated and distributed quarterly? In this category, I'll put no, because I do it monthly, and same as yearly. And then, are your indirect costs calculated and never distributed? No, because I do distribute them. Do you have a way of calculating the work in progress to track how much has been spent on a project? Estimate how much it will complete the project and the original contract amount. So this is essentially, do I have a work in progress spreadsheet or a program, and am I using it? Of course I do. I believe that's very important. So our total is 15. Timely financials. Accounting information gives the management team the health of the company. We refer to financials as the income statement and balance sheets. So, are your financials prepared monthly? No, we prepare them quarterly. Are they prepared yearly? Are your financials never prepared? And if they are not, I highly suggest you look into this, because you will be essentially breaking the law by not paying taxes and avoiding taxes, which it is possible for small companies to avoid these financial calculations, basically your books. now we'll look at heavy operating expenses and determine our operating expenses. Spending money for an office overhead can get out of control if it's not managed properly and accounted for in each project estimate. Also, because of the nature of construction, there is a significant amount of overhead that is required just to start the project. You have to pay for trailers going out there, you have to pay for project setup, and you have to pay for accountants and purchasing agents. A company needs to have the proper project management software, work trucks, computers, large offices, and maybe even warehouses for a project. This accumulation of overhead can lead to business failure when the overhead exceeds the break-even point of the company's finances. We'll analyze the overhead by determining the percentage of overhead to revenues. This will allow us to see how much overhead your company is using. We assume that having an overhead percentage over 90% of revenue is heavy. So you're using 90% of what you're taking in on your internal operating costs. So first column we fill in is our total operating overhead. So we have a total operating overhead of $350,000. We have staff in-house, we have warehouses, and our total revenues are $560,000. So our percentage operating expenses is 62.5. We're using only 62.5 of our revenues on operating expenses. So this tab automatically calculates our points. The value is greater or less than 90%. We're less than 90%, so we get 10 points. And our suggestion is that the overhead is not determined to be burdensome. So we are managing our overhead and not utilizing low overhead on our projects. We'll talk about overexpansion now. When a business expands in an uncontrollable way or too quickly, inefficiencies can cause a loss of cash flow, profit, and sometimes customer satisfaction. When a construction contractor expands, they're essentially taking on more projects and different type of projects, or they may be going to a different location. As such, this requires that the business has enough capital and employees to manage these new projects. The cause of failure will be from taking unprofitable jobs because you're trying to get your foot in the door in different industries and you're expanding. Several unprofitable projects can ultimately lead to business failure, what I found in my research. So it'd be a good idea to look at the overexpansion section in the narrative to understand what these questions are. The first being, have you determined what your core mission is? Have you set your market? Have you set the what you set out to do? And my company has done this, and we do have a core mission of obtaining clients in several different sectors. So have you defined your external baseline? And that's your market. What are you good at? What can you do well? What do you know well? What does your project team know well? And I feel I have defined my external baseline, so I'm going to put yes. Are you able to differentiate? This may seem counterintuitive, but can you get into different markets? If you believe you can, then overexpansion will not affect you quite as much as if you're not able to differentiate. And unfortunately, my company's good at one thing, or a couple things, but not so good at differentiating, so we're going to have to put no. So our total is 4 points. Now we'll look at procurement problems. We're going to refer to procurement as the process required to supply equipment, materials, and other resources to carry out the project. There are many risks involved with procurement of material because of the several parties involved. You have your company, your purchasing agent, your supplier and their purchasing and their warehouse and your warehouse. And the complexity of these material purchases can be overwhelming to some companies. So we're going to look at the questions we have to determine if you're procuring material well, or if you have the proper mitigation strategies to decrease your risk. So are your purchase orders reviewed by more than one person? So if you're just one person contractor, then you can put yes here. But if you're only having one person review them and not signing off on them, it'll be bad. It'll be easier. More problems will occur. So my company does. Do you require supplier confirmations? I don't really, so I'm going to go ahead and put no here, and that'll be 0 points because sometimes my suppliers don't give me a confirmation, which I should change. Are contingencies in place for material shortages? So if you're short on material, what are you going to do? How are you going to solve that problem? Because in construction, material shortages will lead to schedule problems, and that can lead to more money on a project and not a happy owner. So yes, we do have contingencies, and the narrative explains a few contingencies on how to mitigate material shortage risks. Are long lead times calculated for each order? Yes, absolutely. Long lead times will kill your schedule, so you need to calculate them, and my company does, so we will receive a point for that. Insurance and EMR. Sufficient insurance is vital to for the sustainability of any business. In any industry, a company needs insurance just in case something happens. Because of the dangerous working nature of construction, contractors are at high risk for insurance claims and need to have proper coverage. Contractors not covered, the parties suing can go after company assets and even owners' assets depending on what type of business structure it is. Also, a safety incident can affect the experience modification rate, or the EMR. The EMR is a number that compares the actual losses to expected losses in workers' comp insurance. Some owners and contractors require the EMR be under 1 and will not award you a job because of a high EMR. So if an incident happens on your site and you have to pay out workers' comp, your EMR will go up, and that will be detrimental to your possible jobs that you can obtain, because contractors won't hire you, owners won't hire you. So the first question is your company insured? Yes. Although this is a broad question, because there's so many different types of insurance out there. A basic insurance, a builder's risk insurance, is absolutely vital, and so I have mine, and we're okay on that aspect. And what is your EMR rating? My EMR, unfortunately, we've had some accidents on my projects, so my EMR is 1.7. It's not looking good. So because of that, I have 0. So I need to up my safety program and hopefully lower my EMR. We have a total of 9 points in this category. Now in this section we'll talk about the business plan. And this may seem like common sense to have a business plan, but many companies don't. Or they have something they call a business plan, but it's actually not really a plan at all. So a business plan is a well thought out framework which attempts to anticipate and answer many of the problems the business will encounter. The creation of this business plan requires extensive research and general business knowledge in order to accurately anticipate these business problems. A business plan's value is that it should help increase the odds of one's success. Essentially, the plan is a roadmap that outlines the company's goals and objectives. So do you have a written business plan that is coherent and well developed? I absolutely do have a business plan. I'm a believer in planning for what you want to achieve, and without a plan, I don't believe you can do it. So my company has created a plan, and I'm carrying out my mission and values. Now we'll talk about industry weakness. The objective for the firm in a recession is to remain in business in order to gain from the profitable work when it's available again. If you don't remain in business, you'll become the statistics I talk about in my literature review, and many, unfortunately, companies do because they can't remain in business during a recession. So the questions here will help identify the potential problems your company may encounter during a recession. Do you bid projects at cost to keep busy, not for business development purposes? Now I put in there not for business development because I bid them low if I want to get into a new sector, or if I'm doing a favor for a client, I might put it a little lower. But as far as keeping busy, no, I do not. And the reason why I have this question is covered in the narrative. Do I have liquid assets, and am I able to do layoffs? So, am I able to sustain profits by cutting costs? Yes. I can liquidate my assets. I can get rid of inventory in my warehouse, and as much as I don't like to say it, I do have the power to do layoffs for my employees. So have I changed my core market in an attempt to be awarded work, not to expand the business? Yes, I have actually done that. Times are rough, and I have had to expand my work in a down market. So we have a total of 3 points in this category. The final category, before we review the assessment and analyze it, is price increases. So price increases will occur during the life of a company. It's inevitable. It's inflation, and unfortunately it happens. There are clauses that company must have in place in order to protect themselves from pricing escalations. And we talk about this in the narrative and explain the clauses in depth and actually give examples of the clauses. So do I have a material price escalation clause in my contract? Yes, I do. Every contract that I sign with an owner, I include a material price escalation clause. So do my suppliers notify me how long prices are good for? So sometimes suppliers will say your price is good for 30 days, or it's good for 60 days, or sometimes they don't say it at all. And unfortunately, they don't. So I'm going to have to go ahead and put no in this category. So I might be liable for price increases because I don't look out for that often, as much as I should. So now we'll go through the risk assessment and analysis based on the points that we've talked about here. We'll now go over the risk assessment analysis chart that covers the totals of each category. So under financial risks, we had a total of 125 points available. My points totaled up are 98, and so unfortunately I did not do quite as well in this category, but I fared decently, being close to 100 points. And the reason why the financial category has such a heavy point value of 125 compared to the managerial and uncontrollable is because, based on my research, most firms fail because of poor financials. Managerial totaled at 50, and I had a total point value of 42. So in this category, I did do better than the financial. However, I did lose some points on the overexpansion portion and also the procurement portion. So there's some room to improve here. The total uncontrollable point value is 10, and I had a total of 6. And so I'm vulnerable. My company is vulnerable to uncontrollable risks and how I perform in weak times and bad economies, and also how I manage my price increases and inflation. So the total overall company risk is 146 out of a total available of 185. And my risk analysis standing is company is in decent standing but has potential risks. So there's areas to improve, and there are potential risks based on my answers. But according to what I've come up with, my company is in good standing, and is not vulnerable to risks at this time. So I hope you enjoyed going through this chart, and I hope this is useful when you go through it for your own company. I highly suggest reading the narrative prior to starting this because it does explain these more in depth than what I went into them. But I hope this has helped in reviewing the basics and the how to actually go through the chart and how to answer the questions. So good luck, and thank you for your time.